So starting with exercise number 1, let's look through this story here, and we have to figure out what are the relevant costs, relevant revenues, sunk costs, and opportunity costs. So this is a boutique novelty store. It says they just spent $4,000 on a new software program or inventory. And let's see, they decided to hire either 2 part-time college students or 1 full-time employee. If they hire the college students, they each work 20 hours per week. I think this is similar to one we saw in the chapter, isn't it? And they would earn $15 per hour. If they hire the full-timer, that person works 40 hours per week, also earns for $15 per hour. Did we do this one already? I mean, it looks exactly like one we did already, or am I imagining things? There was $2 per hour in benefits. I think we did this. We didn't?
No.
Wow, okay. All right, so it says that the employees each get 2 polo shirts. Yeah, it was a similar one, I remember. There was the one with the hairnets and the gloves. Yeah, it's very similar, okay. So each employee gets 2 shirts, and the shirts cost $10 each. So what are the relevant costs, relevant revenues, sunk costs, and opportunity costs? Let's just go through one at a time. The $4,000 on the new software program, what kind of cost is that? Sunk, okay. And the 2 part-time college students working 20 hours a week, or the 1 full-timer working 40 hours per week. In each case, it's the same $15 per hour. Are those relevant costs? It comes out the same, right? We just look at the number of hours and the cost per hour, it's the same. So that's not really relevant, we'll just ignore it. On the other hand, as somebody pointed out in the similar example, this $2 per hour in benefits, that is relevant, right? Because the part-timers don't get the benefits. So if they hire the 2 part-timers, that's going to save them $80 per week. So relevant cost is the benefits of $80 per week. Now, what about the polo shirts? Did they make up a relevant cost? What do you think? Correct, because it's a matter of 2 employees with 2 shirts each, which would be 4 shirts, or 1 employee with 2 shirts. So there is going to be a difference, right? It would be $40 with the part-timers versus $20 with the full-timer. So polo shirts, but really it's a difference of $20. Is there any difference in revenue? I didn't see anything about revenue. And there were really no opportunity costs mentioned here. So that's basically it. So we had relevant costs being the benefits and the polo shirts, sunk costs for the software. Any questions or comments? Okay. So number 2, this person is doing a training seminar in Philadelphia. Okay. And before that, he's going to be in New York City. Says he'll stay in Philadelphia the night of the seminar. Then the next morning, he'll meet with clients. He has two options, basically fly or drive. So if he flies, the cost of the flight is $287. He's going to have some Uber fees of $68. He has a meal per diem. If you're not familiar, a per diem is when you're allowed a certain amount of money per day, which is what per diem means, I think. I don't speak Latin. But in this case, for each full day that he's traveling, he will get $40 that he can then spend on food. And for each half day he's traveling, he gets $25. And the hotel costs $225 per night. Okay, so that's one option. The other option, let's see, rent a car. The rental car with gas comes out to $57 per day. He'll need it for 2 days. And then he goes back to New York City, and we have to figure out what are the relevant costs, revenues, sunk costs, and opportunity costs. Okay, so again, let's just go through it one at a time. The cost of the flight, would that be relevant in making the decision? It is, because if he chooses to fly, he has that cost. But if he chooses to drive, he doesn't have that cost, right? So it would be relevant to the decision. So flights, I'll put the amount. Oops, 287. The Uber fees, are those going to be relevant? Obviously, if he rents a car, he doesn't have to take Uber because he's got the rental car. So yes, if he flies, he has the Uber fees. If he drives, he doesn't. So it is a relevant cost. Now the per diem for meals. I've read this exercise many times, and I don't really understand how they get this. The official answer says that there is a half-day difference. I don't think they gave us quite enough detail to understand exactly like why there's a half-day difference between flying and driving. Maybe you can find it in there. I can't figure it out. But according to the textbook, there is a half-day of per diem difference. So that would be relevant between the two options.
Yeah, I don't want the full shift.
Maybe, I don't know. Like I said, because it says if he drives the car, he needs the car for 2 full days. But is that just because rental car companies charge you by the day? I don't know. Like I said, I've tried to figure it out. I can't figure it out. But it doesn't, it's okay. It doesn't really matter. We'll just go with the official answer here. So far, those are the relevant costs. What about the cost of the hotel? He is going to need that if he flies. Will he need the hotel if he drives? I would think so, unless he's going to sleep in the car, right? So I don't think the hotel is relevant then, because it's the same cost either way. What about the rental car? That cost would be relevant, right? 57 per day times 2 days, so $114 for the rental car. Okay. Was anything mentioned about revenues? Not in this example. There were no revenues. There really weren't any sunk costs either. And there really were not any opportunity costs. So we really just had the flight and the Uber versus the rental car. And then somehow they figured out a difference of half a day of per diem. So that should be all there is. They had airfare, car rental, Uber, and a half day of per diem. Okay, any questions? All right, this one I think is a little easier because we're actually going to break it down. It's a similar kind of example. So Bridget here is going to make a presentation, and let's see. Okay, she's making a presentation at a university. It's 196 miles from her office. She needs to leave work by 1 if she drives her personal car. She'll be reimbursed 50 cents per mile. And let's see, it says she can spend the night. There's a place she can stay for $101 per night. Okay, so that's one option. The other option, she could fly. Round trip costs $300. She will need a rental car, $39 per day. She'll have to pay parking, $25 per day. She also gets a per diem of $35. And it says it's going to be the same per diem whether she flies or drives. Okay, so which is going to be more economical? We'll solve A and B together using this table down here. Basically, we'll compare the cost of driving and the cost of flying. So under cost of driving, the first thing we have is mileage. So with what we know, what's it going to cost her, or what's it going to cost the company for mileage reimbursement if she drives? Okay, $98, and that'll get her there, right? That'll cover the 196 miles to get there at 50 cents per mile, but she has to get back too, right? So then we'll double that and it comes out to $196, right?
Yeah.
So round trip, that's going to cost the company $196. She has the $110 cost, or I'm sorry, $101 cost of the hotel. The per diem, it's going to be, again, the same in both cases. It's going to be $35. So it's not relevant, but we'll go ahead and include it here in the table anyways. And then let's compare that with flying. So flying, she does not need to stay in the hotel. She's got $300 airfare. And then the rental car plus parking comes out to $64. So if we total it all up, we get $332 if she drives. That's the total cost. And $399 if she flies. Okay, so laying it out like that, it's pretty easy to see the comparison, right? We can see the difference between these relevant costs, see how the irrelevant costs are the same in both cases. and the total cost in both cases. So any questions so far? Okay, so then it says, what is the relevant cost of driving? So how would we figure that out? Just the relevant cost of driving. Okay, it's the 196 and the 101, so that's $297. And then what is the relevant cost of flying? That would be just the 300 and the 64, right? So then the differential cost is the difference between the two. So the differential cost is $67. In other words, it costs $67 more for her to fly than to drive. You could also calculate that by subtracting the total cost to drive from total cost to fly, or relevant cost to drive, subtract from relevant cost to fly. Either way. And the last part is, what other factors should she consider in her decision? So yes, it's cheaper to drive, but what other factors are there to think about?
She make it like an outfit, so it might be potentially bad for her outfit.
Okay, so impact on health. What else?
More exposed to like accidents.
Okay, the safety. You're probably safer in a plane than you are on the highway. That's what statistics seem to show from what I've heard.
They're gonna reimburse her miles, but like she's driving the car more, so the car's gonna be more prone to need out to work, like maybe.
Okay. Okay, so wear and tear on the car, basically. I think I spelled that right. Wear and tear. What else? What was that? Convenience. Okay, which is more convenient? Some people might find flying more convenient. Some people might find driving more convenient. What about in terms of productivity? Like if you're in the plane, you could work on your laptop. If you're in your car, you could have phone calls while you're driving, potentially. That might be a factor. What about stress? Some people don't like to fly, right? Some people don't like to drive. So it could actually impact their stress level. Anything else come to mind? Time? Okay. Yeah. It's going to be a more efficient use of time. Okay, I think we hit some of the major things there, so that gets us an idea of some of the qualitative considerations. Any other comments on this one? Okay, well, let's go on to number 4 then. Okay, this company sells printers for $55 per unit. Here are the costs. There's a special order to purchase 15,000 printers, okay? That means that customers come to them and said, we want 15,000 printers, but we want something different than your normal product or different from your normal price, right? That's what makes it a special order. They do have the idle capacity, so they can take the order. They will have an additional $2 per printer in labor costs if they take this order. And 1/3 of the manufacturing overhead is fixed and is not avoidable. But that means the other 2/3 of the overhead is avoidable. The question is, what is the minimum selling price that they should accept for the special order? And basically, the way to answer that is to figure out what are the costs for this order. So if we could figure out what are the variable costs and the avoidable fixed costs, that would be the absolute minimum price, because anything lower than that, they would be losing money on the deal. Now, if they go exactly with those variable plus avoidable fixed costs, then they're only breaking even. And that's generally not what you want to do, but that's how we'll answer the question. That would be the absolute minimum price we would want to charge. So let's go ahead and break it down by the type of cost. There's direct materials, direct labor, and manufacturing overhead. If they take this order, what is going to be their direct material cost per unit? It'll still be $14, that's right. Now, what's going to be their labor cost per unit? What was that? 20? Well, remember, they do have the additional $2 for this particular order because it requires some additional labor. So we add that in and it's 22. Okay. And then we were told that the manufacturing overhead, which is $3 per unit, 1/3 of that is fixed and not avoidable. That means $2 is avoidable. So we should include that, because if we accept this order, we're going to have those extra $2 per unit of manufacturing overhead costs. So we add that all together, we get, what is that, $38? Right, $38. So what is the minimum selling price we should accept? It would be $38 per unit. You don't have to, but if you wanted to multiply that by the 15,000 units, it would be 570,000 total. That'd be the minimum we would want to charge for this order. Yes. Okay. Any questions on that one? So again, in this case, manufacturing overhead, some of that was avoidable, some wasn't. So we had to take out the 1/3 that was not avoidable, and the other 2/3 we included in our calculation. All right, number 5 then. So a lot of this information is not really necessary to solve it. This company, they make oak shelves, blah, 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 blah. They have a special order to make 1,200 shelves. The customer is willing to pay $26 each. It does say here that the shelves can be packaged in bulk for this special order. So that's going to actually save the company money compared to their normal orders. And there's normally a variable cost of $27 per unit. The question is, again, the minimum price per unit that the company should accept. So actually, it's really easy to solve this one. If we say normally there's a variable cost of $27, but we're going to save $1.50, That means we can sell these units at $25.50. That would be the lowest, because anything lower than that, then we're losing money. Now we're only breaking even at $25.50. So again, that's not necessarily the price you want to charge, but that would be the minimum we could charge without losing money. The variable costs minus these cost savings. So our answer here is $25.50 per shelf. Yeah. Just designed to confuse us. So that one wasn't so bad, right? Let's go on to number 6. We've got a deli that makes rolls for their sandwiches, and they use 30,000 rolls annually. Here are the costs for making these rolls. A supplier offers to sell them the rolls for 90 cents each. If they do that, then they're going to avoid 30% of the fixed overhead. So again, we have to then figure out a price per unit and compare it with what the other company is offering. So if we go direct materials, direct labor, variable overhead, and then the fixed overhead. And then we'll figure out the total. So what is going to be our direct material cost per roll? Now wait a minute, this is if we make it, right? Well, it says 24 cents per roll, right? And our direct labor is 40 cents. And our variable is 16 cents. So all of that was provided to us. The calculation we do have to make, though, regarding the fixed overhead, it says 30% of that can be avoided. So that's what we want to consider. What would be 30% of our fixed overhead per roll? $0.06. Normally 20 cents of fixed overhead, 30% of that can be avoided. So we just multiply it by 30%. And yes, it comes out to 6 cents. So that's the part we want to factor into our calculation. Now, if we add it all up, I get 86 cents. Is that right? Yeah, 86 cents. Okay. So in other words, if we make it ourselves, it's really costing us 86 cents per roll. And if we don't make it ourselves, that saves us 86 cents per roll. The rest of the fixed overhead costs we're going to have either way, right? The rest of the fixed costs are unavoidable, so they're really not relevant. Now, if the other supplier is willing to sell us the rolls at 90 cents each, that's more than our cost. So if we do accept the offer, we're losing 4 cents per roll, right? We have to pay an extra 4 cents per roll compared to our costs. And there are 30,000 rolls a year. That means our profits go down $1,200. Right? So think of it this way, minus the 90 cents equals a loss of 4 cents times 30,000 rolls equals a loss of $1,200. So that is our answer. Our profits are going to go down by $1,200 if we outsource the production of the rolls. Any questions? Okay. We did number 7 already, right? So we can skip that one. And let's go to number 8. Okay, so this company is trying to decide whether to continue its costume segment. That's this column right here. And it says neither the direct fixed costs nor the allocated common fixed costs can be eliminated. So these direct fixed costs and these allocated fixed costs, even if we get rid of the costume segment, those costs do not go away. So if we do get rid of the costume segment, what's going to be the impact on our overall profits? That is exactly right. We're going to lose this contribution margin because if we get rid of this segment, we lose these sales. We also lose the variable costs associated with those sales. And the difference is the contribution margin. We still have these direct and allocated fixed costs, so those don't go away. So really, it's just this top part that changes. So yes, Drew is correct. The profits will decline by $76,000. So isn't that interesting? Because it shows the costumes division has a net income of negative $4,000, right? It's losing money. But if we get rid of it, we're going to lose $76,000, not $4,000. So we're actually better off keeping this segment of the company that's losing money because it's helping cover some of those fixed costs. All right, any questions on that one? Okay, so we're up to 8. Well, that was 8, and then we go to 9. Oh yeah. All right, so the underground food store, that sounds sketchy. It has 4,000 pounds of raw beef nearing its expiration date. That's also sketchy. Each pound has a cost of $4.50. That's actually a sunk cost because they already have the beef. It's nearing its expiration date. You know, they can't return that beef back to the ranch, right, to get their money back. So that's a sunk cost. So it's not really relevant. Their options at this point is they can sell the beef as it is for $3 per pound to the dog food processing plant, or they could roast the beef and sell it in the deli. If they roast it, it's a cost of $2.80 per pound, and they can sell it for $6.50. Okay. So if we sell it as is, we're going to get $3 per pound, which since it cost us $4.50, we're losing money, but it's still better to get something, right, at this point. So at least we get $3 per pound if we sell it to the dog food processing plant. Let's compare that with roasting. What's going to be our net gain if we sell it, if we roast it and sell it as roast beef? What's that? No,
70 cents.
and that's not it either. So again, if we roast the beef, it's going to cost us $2.80 to do that on top of our previous costs. But then we can sell it for $6.50. So that means the relevant difference is the difference between those two. $6.50 minus $2.80. So in other words, if we roast it and sell it as roast beef, we make $3.70 per pound, right? Versus $3 if we sell it to the dog food processing plant. So we come out a little bit better by selling it as roast beef. Now, in both cases, we already had a $4.50 cost per pound. So we're losing money either way. But at least if we roast it and sell it as roast beef, we're not losing quite as much money. Okay, so again, our options were as is for $3 per pound, roast beef for $6.50 minus $2.80, which comes out to $3.70. Right, those are our choices. If we look at just the relevant options at this point, it's a simple choice between sell it for $3 or spend the extra $2.80 and sell it for $6.50, giving us a net benefit of $3.70. So we are better off roasting it, right? Because we get more of a gain. Right, 70 cents per pound more than selling to the dog food plant. Okay, does that make sense? I think we did number 10 already as well, right? Okay, so that means on to 11. Anyone need time on number 9 still? Okay, so 11 was the khaki company again. In this case, a lot of the data are the same. It's 15 minutes for shorts, 24 minutes for pants. Contribution margins are the same. 48,000 hours available. The question, the only thing that's different here is the question. How much will profits increase if 100 more hours of machine time can be obtained? So remember from our previous analysis here, the pants were more profitable, right? They had an $80 contribution margin per machine hour, right? So if we have 100 more hours, we should use that for making more pants. And let's see. So we have to figure out how much is our contribution margin going to increase if we have 100 more hours? How can we figure that out? What was that? 80 times 100? Yeah, I think that's right. I think that's right, because $80 of contribution margin per machine hour, we have 100 more hours. Makes sense. All right, let's double check that. Yep, $8,000. All right, so we're done with the exercise set. Any questions? Okay, well, we have 5 problems to go through. Chapter 10. Okay, starting with problem number 4. Okay, here we have a small construction company. And they normally charge $400 a day plus materials. Their client needs a room converted into a bathroom, and let's see. The company produced a bid for $5,000 for the work. However, oh, here we go. There's the $5,000 bid. So the client, which is technically the social services department of the town, asks if the bid can be reduced to $4,000. So should the company accept the offer? Well, here's the bid. Obviously, the company has to cover their materials, cover their labor costs, and their variable overhead. Their fixed overhead, you could look at it either way, right? Because their fixed overhead is probably being covered by other work. So you could take that out of the equation if it's not specifically related to this job. And the company doesn't have to make a profit. So they could cut out $1,000 here, basically accept the offer, but just break even by only covering their variable costs. Right? So if you cut out the fixed overhead and profit from this particular bid, you're covering your variable costs, but you're not really making any profit, right? So the question here is, should the company accept that offer? Would you? Would you take a job just to break even on it? Probably not, right? So let's go ahead and say no. No, because we would only break even. The second question, how much would the income be reduced? Well, obviously, the difference between 5,000 and 4,000 is a difference of $1,000, right? So that's what they mean by that question. Now, the last question here, if the social services department agreed to give an additional job if they accepted this job for 4,000. So if the company takes this job at break even, but they get another job, then should they do it? Kind of depends on that other job, right? If the other job is also going to break even, then no thanks. So the answer would be yes, as long as the new job meets the company's profit expectations. And a lot of times companies will be willing to do work at break even or even a loss if it's going to mean more work in the future, that is going to meet their expectations. All right, any questions on this one? Okay, so next is 5. Okay, oops. Try that again. This one looks scary. It's really not too bad. Just try to get it to fit a little better. Okay, so this company makes executive limousines. They manufacture mini bar insets for their limousines. And these are their current costs. They have an offer from another company to make these insets for $2,100 per unit. And that is for 1,000 of these units. It says that if they accept the offer, and they shut down production for this part of the business, the production workers and supervisors will be reassigned, so nobody's going to lose their jobs. And the labor costs, including the supervisor salaries, will be eliminated. So basically, we're shifting these workers to another area. The company's still going to have those costs, but this part of the business will not have those costs. There's some specialized equipment that has no market value. So we're not going to be able to eliminate the rest of the fixed costs. Only the supervisor, only the supervisor salaries. That's the only fixed cost we'll be able to eliminate. And if we do outsource, then we can lease the space that we're no longer using and make $55,000 per year. So based on this information, we're going to start by putting in our variable costs if we were to make these 1,000 units. So it's $950 per unit for materials times 1,000 units. So that's 950,000. Then direct labor, 650 times 1,000. Variable overhead is 300 times 1,000. And if we add it up, we get $1,900,000 of variable costs. Now, if we buy the units, then we don't have to make them ourselves, right? So our variable costs will be 0 for production, which means we're going to save. Actually, I'll just do it like this. We're going to save all of these costs. That covers the variable cost section. In the fixed costs section, we've got, again, this is per unit. So it would be $500,000 of equipment depreciation, $200,000 of building depreciation, and $300,000 of supervisor salaries. No, 300,000, sorry. And that totals $1 million of fixed costs. If we buy the inserts, we're still going to have the equipment depreciation and the building depreciation. So there is 0 difference in those two costs. However, the supervisor's salaries, remember, are going to get shifted off to another part of the business. So this part of the business is not going to have those supervisor salary costs. And so that's a $300,000 savings if we outsource. So the total fixed costs if we buy the inserts is 700,000. And the total difference is 300,000. Okay, you see how that works? Basically, we're taking this column in the middle minus the cost on the left to get our difference on the right. So what it tells us so far is basically we'll save, if we outsource, we'll save 1.9 million in variable costs. We'll save 300,000 in fixed costs. And now we have to go to this last section. the leased space. Remember, if we outsource, we're going to generate $55,000 in revenue from leasing out the space. So that will help offset some of the costs. Obviously, if we make them ourselves, there's no cost to purchasing the insets, but if we purchase them, it was $2,100 per unit. So that's going to mean $2,100,000 if we buy 1,000 units. So that is obviously the additional cost if we do buy them. We can now add up this section. We get 0 here. We get 2,045,000 here, and same thing over here. Then we can add variable costs plus the fixed costs plus the other costs. So that gives us a grand total of $2,900,000 if we do it ourselves. $2,745,000 if we outsource. And that is a difference of $155,000. Which problem was that?
One.
5?
Yeah.
Yep, 155,000. Okay. So again, this is the cost. We make them ourselves. The middle is the cost if we purchase. And over here we have the difference. So should the company make or buy the mini bar inserts? What do you think? Okay. Based on our quantitative analysis, we should buy the inserts and save $155,000. Now, again, there could be some qualitative factors, but they didn't ask us to think about that. So just based on the financial analysis, yes, we're better off buying. Okay, any questions on that problem? All right, I think we're down to 9, 10, and 11. Oh, how are we doing on time? Let's see. These are going to go pretty quickly. So we might go a little bit past 2:40, and then we'll be done. So if that's okay with you, we won't bother to take a break. We'll just wrap it up. Okay, problem 9. So this company, let's see, it's a publishing company. These are 3 different movies that they have, I believe. Anyways, whatever they are, 3 different products. And the decision is which titles to drop. So the first question, what is the total income if they produce all titles? Well, we have 20,000 plus 30,000 plus 40,000, right? So the total income is going to be $90,000 between all 3 titles. Then the question arises, if title X were dropped, what would be the effect on net income? Well, obviously, if we drop title X, we lose $100,000 in sales and $50 in variable costs, which means the net impact is $50,000 in contribution margin. However, we have to consider these fixed costs. Are we going to lose these fixed costs or not? The direct fixed costs seem to be directly associated with Title X. So those costs, if I'm interpreting this correctly, will go away. The allocated common fixed costs are not going to go away because those are just costs that corporate decided we were responsible for. So I believe we are going to see our net income go down by $30,000. Is that right? Yes, because we have $100,000 in sales, minus $50,000 in variable costs, and $20,000 in fixed costs. Let's see if I can check that answer without giving away the next, oops, did it again. The next one. No, I can't, but anyways. Okay. Oh, I didn't even, I looked at the wrong one, actually. $30,000 difference, okay. So the impact would be a $30,000 decline, so minus $30,000. Yeah, our net income would go down by $30,000. Question C, how much did Title X contribute to fixed costs? Well, again, these direct fixed costs were only for this product. So what they really mean is this $10,000 of fixed costs that were allocated from corporate were covered by Title X. So if we get rid of Title X, those $10,000 get shifted over to the other products. So the answer is the Title X contributed $10,000 towards the fixed costs. Now determine the cost that will remain even if they drop Title X. Well, that's also $10,000, right? And which costs and amount will be eliminated if Title X is dropped? Okay. So we're going, if we drop Title X, we're going to eliminate variable costs and direct fixed costs. So that's a total of $70,000 in costs that would be eliminated. So let's take a look here. So we said 10,000 for C, 10,000 for D, 70,000 for E. Okay. Any questions on problem 9? So problem 10 is actually super easy. This company has 2 products, Y and Z. They have costs of $36,000. Product Y weighs 25 pounds. Z weighs 75 pounds. Sales price is not relevant. If we are going to base our costs on physical measure of output, in other words, on the weight of the products, how would we allocate the costs? Okay, so first, they told us Y weighs 25 pounds, Z weighs 75 pounds. Total of 100 pounds. Right? So if we're going to allocate these $36,000 in costs based on weight, what percentage would go to product Y and what percentage would go to product Z?
25%.
25% and 75%, right? So 25% of $36,000 is 9,000. And 75% is 27,000. We take those costs and divide it by the weight of the two products, and that's how we would allocate the costs. All right, any question on number 10? Okay, then our last problem. Okay, this company has, they produce skirts and jumpers, okay? And they have scrap cloth. So we've been selling the scrap cloth for $3.25 per pound. However, we could take our 40,000 pounds of scrap and we could make 10,000 teddy bears. So should we do that? Let's see. The variable cost to produce the teddy bears comes out to $3.85 per unit. Fixed costs would increase by $95,000 per year. And we could sell 10,000 teddy bears for $18 each. So what should we do? Okay. Well, let's fill in the information. So the selling price per pound of scrap was $3.25. And there is no cost to us to sell the scrap. That means we have a $3.25 contribution margin per pound of scrap. We can sell 40,000 pounds. So we could simply multiply, right? And get our total contribution margin of $130,000. Would we have any additional fixed costs if we sell the scrap? No. So basically, God bless you, we would increase our net income by $100,000 if we sell the scrap. On the other hand, if we do the teddy bears, it's $18 each. Our variable costs were $3.85 per bear. So how do we get our contribution margin per bear? Sales price minus variable cost, right? So $14.15 of contribution margin. We could sell 10,000 bears. So that makes $141,500. That's looking pretty good so far. However, fixed costs, right? We need this $95,000 of packaging equipment. So our net income is only going to increase by $46,500. So now that we've done this quantitative analysis here, what should we do? Sell the scrap. Yep. Sorry, teddy bears. Sell the scrap because the effect on operating income is greater. Okay. Great. Any questions? All right, well, thanks for hanging in there. And we're done, so enjoy your spring break. See you all the week after.